I want you to think about something for a moment. Think about the last time you checked your bank account and felt a quiet, low-grade panic. Not a crisis, not an emergency. Just that steady, familiar hum of worry that lives somewhere behind your ribs. Most people feel it. Most people never talk about it. And most people never do anything about it, not because they don't care, but because nobody ever sat them down and told them the truth in plain language. That's what today is about. Not charts, not formulas, not the kind of financial advice that sounds smart at a dinner party, but falls apart the moment real life shows up. I want to talk to you the way I'd talk to someone I care about, someone who's got more potential than they're currently putting to work. Someone who, if they make a few adjustments right now, in June, at the midpoint of the year, could look back on this moment as the turning point. Because here's what I've learned after watching money move through good markets and terrible ones, through booms and recessions and every kind of panic in between. The difference between people who end up financially secure and people who don't is almost never intelligence. It's almost never income. It's almost always behavior. And behavior can be changed right now, starting this month. So let's talk about it honestly. The most common financial mistake I see Americans make isn't spending too much on coffee. It's not avocado toast or subscription services or any of the things that personal finance writers love to mock. The real mistake is far quieter and far more expensive. It's the mistake of drifting, moving through the year without intention, making the same automatic decisions in January that you made in December and December before that because you never stopped to ask whether those decisions still made sense. June is the most underrated month in personal finance. Think about it. The year is half over. You've had 6 months of real data, what you actually earned, what you actually spent, what you actually saved. Not projections. Not goals written in a journal in January when you were feeling optimistic. Real numbers. And most people look at those real numbers, feel a wave of embarrassment or guilt, and then do absolutely nothing with them. They carry the regret forward and hope the second half of the year magically corrects itself. It won't. Not without a plan. There's a concept I want you to understand, because once you see it, you can't unsee it. It's the idea that most financial pain is not the result of one catastrophic decision. It's the result of small, invisible choices compounding silently over years. The same way that good decisions compound into wealth, mediocre decisions compound into stagnation. You don't notice it happening. Let me give you a picture of what I mean. Imagine two people, same age, roughly the same income, both living in the same city, both with the same general sense that they should probably be saving more. The first person does what most people do. She carries a low-grade financial anxiety but keeps it in the background. She saves a little when she has extra. She invests occasionally when she remembers to, when it feels safe, when the market has been going up and the news is calm and the mood is right. She checks her portfolio when things are good, feels confident, maybe moves some money around based on something she read. When things are bad, she checks less. She doesn't sell exactly, but she stops contributing. She waits for clarity. She waits until it feels right again. The second person is not a genius. She doesn't watch financial television. She doesn't trade. She picks a simple, boring strategy in January. She automates her contributions so the money moves before she can touch it. She does not look at her portfolio every day. She does not make changes based on what the market did last week or what some commentator said was coming next quarter. When the market drops 15% and her coworkers are anxious, she goes for a walk and contributes anyway. When the market is up and everyone feels brilliant, she doesn't add extra or get clever. She just continues. month after month, year after year, decade after decade. 20 years later, those two people are in completely different places. Not because of income, not because of luck, because of the quiet, unsexy discipline of the second one. I want to be honest with you about something that most financial content won't tell you. The market itself is almost never the problem. The investor is almost always the problem. And I say that with enormous respect because being a bad investor is not a character flaw. It's a deeply human response to uncertainty. Our brains were not designed for this. We evolved to react to threats immediately, to run from predators, to change course when something feels dangerous. Those instincts kept us alive for hundreds of thousands of years. They are terrible, terrible tools for investing. When the market falls 10%, your brain processes that as a threat. It floods you with urgency. Do something, move, get out, protect yourself. And the action that feels most like protection, selling, moving to cash, stepping away, is precisely the action most likely to guarantee permanent loss. Because the market recovers. It always has. But if you've sold, you don't participate in the recovery. You've locked in your losses, and now you have to decide when to get back in. And that decision is even harder than the first one, because now you're watching from the sidelines, and every day you wait feels like another day of proof that you made the wrong call. This is the cycle, and it repeats itself every few years, and it cost ordinary Americans more money last cycle than any fee, any bad fund, any financial advisor ever charged. I want you to sit with something uncomfortable for a moment. Think about the last time the market was rough. Maybe it was a quarter, maybe it was a full year. What did you do? Did you change anything? Did you stop contributing? Did you look at your balance less to avoid the anxiety? Did you tell yourself you'd wait until things settled down? If the answer is yes, even a small yes, you already know that your behavior in moments of fear is not working in your favor. And I'm not saying that to shame you. I'm saying it because recognizing the pattern is the first step to breaking it. Here's a hypothetical that I think captures this perfectly. Imagine a man who started investing in his late 30s. Not young, not early. He felt behind, which is one of the most paralyzing feelings in personal finance. When you feel behind, you tend to make one of two mistakes. You either freeze, you do nothing, because the gap feels too large to close, or you get aggressive and take on too much risk, trying to make back time with bold moves. He did a version of both at different moments. He froze for a couple of years. Then he tried to make it up with some individual stock picks based on things he'd heard. He lost money. He froze again. Then one day someone told him something simple. They said, the question is not how much you've lost. The question is how much time you still have. He had about 25 years until retirement. 25 years. At a reasonable average annual return, money doubles roughly every 9 to 10 years, which means money put in today could double. Twice. Before he retired, he stopped trying to be clever. He stopped trying to time things. He set up automatic investments in a simple index fund. He added a little more each year as his income grew. He did not change course in 2020 when the market dropped 34% in 5 weeks. He watched his balance fall. He contributed anyway. He told me later that those weeks were the most uncomfortable of his financial life. But he stayed in. And by the end of that year, he was ahead of where he started. Not by a little. The lesson is not that the market always goes up quickly. Sometimes it doesn't. Sometimes recovery takes years. The lesson is that time is the most powerful asset you have, and panic is the most effective way to destroy it. Now let's talk about June specifically. Why this month? Why right now most people do their financial thinking in January? New year, new habits, big promises. What happens is predictable. Life gets busy. The intentions fade. By June, the resolution is mostly forgotten. And that's actually the perfect time to revisit it, not with guilt, but with honesty. You have 6 months of real data about yourself. That is enormously valuable. Here's what I'd encourage you to look at this month. First, look at your savings rate. Not your income, not your expenses, your savings rate. What percentage of what you earned in the last 6 months actually got put aside? Not spent on something you wanted, not consumed by something unexpected, but genuinely set aside for your future. Most Americans are saving somewhere between 3 and 5% of their income. The research consistently suggests you need closer to 15 to 20% to build real financial security over a working lifetime. That gap is not a crisis, it's information. It's the distance between where you are and where you need to go, and that distance can be closed methodically. Second, look at whether your money is working or just sitting. There is a quiet tragedy happening in millions of American households right now. People who are actually saving, disciplined, responsible people are keeping too much of that savings in accounts that are earning almost nothing. Money sitting in a basic checking account or an old savings account earning a fraction of a percent is not building anything. Inflation is eroding it quietly every single month. If you have an emergency fund that's larger than it needs to be, the excess is costing you something. And if you have no investments beyond that, you are leaving one of the most powerful tools in finance completely untouched. Third, and this one is the deepest, look at your relationship with discomfort. This sounds strange as a financial topic, but stay with me. The investors who do best over time are almost always the ones who have developed the highest tolerance for sitting in uncertainty without acting on it. They've learned that the urge to do something when markets are volatile is almost always the wrong urge. They've practiced letting it pass. They've trained themselves to distinguish between real threats to their strategy, which are rare, and emotional discomfort about temporary price movements, which are constant. You can develop that tolerance. It's a skill. And like most skills, it gets easier with practice and with time. Let me give you one more image to carry with you. Think about a farmer. The farmer plants seeds in spring. He does not dig them up in July to check whether they're growing. He does not panic in a drought and sell the land. He doesn't abandon the process because one season was hard. He understands something fundamental. The outcome is not up to him day by day. His job is to do the right things consistently, protect what he's planted, not make impulsive decisions based on the weather this week, and wait. The harvest comes. Not always when he expects it. Not always as large as he hoped. But it comes. And the farmers who last, the ones whose families prosper across generations, are the ones who understand that patience is not passivity. Patience is a choice made every single day, not to confuse short-term noise with long-term reality. Your money is a garden. June is a good time to check what you planted, add some water where things are dry, and trust the process. Now let's talk about what clarity actually looks like from here, because I don't want to leave you inspired and directionless. That's not useful. I've watched too many people feel motivated by an idea and then go back to exactly what they were doing because motivation without a structure fades. The most important shift you can make right now is from reactive to intentional. Reactive is how most people manage their money. Something happens, a bill, a bonus, a market move, a conversation with a worried friend, and they respond. They make decisions in the moment based on emotion without a framework. Intentional is different. Intentional means you've decided in advance what you're going to do, and you do it regardless of how you feel about it in the moment. Automating your investments, is not a trick. It's not a gimmick. It is the single most effective behavioral tool available to ordinary investors because it removes the decision. It removes the moment where you look at your account and think, well, things are a little uncertain right now. Maybe I'll wait. You don't get that moment. The money moves automatically. The investment is made, and you go on with your day. If you haven't done that yet, that's your most important task this month. Not picking the perfect fund, not timing the right moment, just making the decision automatic. You can optimize later. The most important thing is to begin and to make the beginning sustainable. The second shift is learning to judge your decisions by the quality of your process, not the immediate outcome. This sounds simple, and it is genuinely hard to practice. A good decision made with solid reasoning can have a bad short-term outcome. A reckless decision can have a lucky short-term outcome. If you judge yourself by outcome alone, you will draw all the wrong lessons from your experience. You will think you were smart when you got lucky, and you will think you were foolish when you were actually right, but early. Neither conclusion helps you. Judge yourself by this. Did I invest consistently without making changes based on short-term emotion? Did I keep my costs low? Did I stay diversified rather than concentrating too heavily on one idea or one trend? Did I save a meaningful percentage of what I earned? If you can answer yes to those questions, you are doing the right things. The outcome will follow, not immediately, not on a schedule you can predict, but over the long arc, which is the only arc that matters. Those behaviors compound into something real. The third shift is understanding the difference between your financial life and the economy. These are not the same thing. The economy is a vast, complex system that involves forces you cannot control and cannot predict. Your financial life is a set of personal choices made over decades. People confuse these constantly. They watch the news, see something alarming about inflation or interest rates or geopolitical tension, and they change their personal strategy in response. As if their retirement account in a broadly diversified fund is somehow the same thing as the macroeconomic situation being discussed on cable television. The economy will have good years and bad years. You cannot control that. What you can control is whether you are in the market over the long term, whether you are saving consistently, whether you are living within your means and using the difference to build something. The economy is the weather. Your habits are the house. Build a good house, and you can handle a wide range of weather. I want to close with something that I think about often. There is a version of your future that is significantly better than the version you're currently on track for. Not because you need to be a genius about it, not because you need to earn more or take big risks or do anything dramatic. Simply because you start making small adjustments now, this month, this year, and then you stay consistent in a way that most people don't, because most people never really decided to. The distance between the life you're living and the life you want to live financially is almost always a discipline gap, not a knowledge gap. People know they should save more. They know they shouldn't sell when things are down. They know time is their greatest asset. The knowledge is available. It's everywhere. What's rare is the person who actually acts on it, not just in January, not just when they're feeling motivated, but every month, in the boring middle months, in June, in November, in the ordinary weeks where nothing is dramatic and there's no external pressure to pay attention. Be that person, not because it's exciting, not because it feels good in the moment. Because in 20 years, the compound effect of that consistency will be the most important financial decision you ever made. And when you're sitting somewhere comfortable with options in front of you that other people don't have, Not because you were lucky, but because you were steady, you will know it was worth it. The year is halfway over. You still have 6 months. Use them. That is enough. That has always been enough.